Welcome to our deep dive on the 6% debt dilemma. Today we will unpack whether you should prioritize paying off a 6.24% APR debt or invest for potential market gains. To guide you clearly, we will compare guaranteed returns against market risk, explore time horizons, and outline a balanced blueprint you can adapt. First, let's set the stage with what this choice really means and why it's often so close mathematically. Here is our agenda. We will begin by defining the 6% dilemma, then move to the case for paying off debt, followed by the case for investing. Next, we will present a balanced financial blueprint and visualize it through decision flow diagrams. After that, we will test your understanding with short quizzes and wrap up with key takeaways and next steps. Now, let's transition into the core dilemma. The dilemma centers on whether a 6.24% APR debt should be paid off first, or whether you should invest instead. A payment toward this debt guarantees a 6.24% return via interest avoided. Meanwhile, investing could yield more, but with volatility and uncertainty, especially over shorter timeframes. With that framing, let's first examine the case for paying off debt. Paying off a 6.24% APR debt delivers a guaranteed, risk-free 6.24% return by eliminating interest costs. In many tax situations, achieving an equivalent after-tax return in a brokerage account could require an 8 to 9% pre-tax return, making debt payoff particularly attractive. Reducing debt also improves monthly cash flow and provides psychological and financial resilience against shocks. When the time horizon is under 5 years, market volatility can easily undercut potential gains, so standard guidance often suggests tackling debts above approximately 5% before investing aggressively. Next, let's explore the counterpoint, the case for long-term investing. Over long periods, broad market index funds have historically produced returns that exceed 6%, allowing compounding to work in your favor. Diversified, low-cost funds spread risk and reduce single-company exposure. Moreover, consistent contributions generally outperform attempts to time the market. With a time horizon of 10 years or more, short-term volatility tends to even out. Therefore, if your goals are distant and you can handle fluctuations, investing becomes increasingly compelling. Now, to compare both sides directly, let's place them side by side. On the left, Debt Payoff offers a certainty equivalent to a 6.24% return and immediately improves cash flow with less anxiety. It is ideal for goals within 5 years and is simple to execute. On the right, investing offers potentially higher returns over longer horizons, benefits from compounding, and fits best when you have 10 or more years. However, it introduces volatility and uncertainty. With that comparison in mind, let's visualize a practical decision path. This flowchart starts by confirming an adequate emergency fund of 3 to 6 months of expenses. If that is not in place, build it first. Next, eliminate any high-interest debt above around 10% APR. Then, secure your full employer match if available, as it constitutes a strong immediate return. If your remaining debt APR is around 6%, consider your time horizon. Under 5 years, favor paying the debt. At 10 or more years, consider splitting or leaning more into investing. 5 to 10 years often suggests a balanced approach. In all cases, reassess at least annually as your income, goals, and market conditions evolve. With the decision path clear, let's convert this into actionable steps. Turn the decision-making process into a repeatable system. First, build a 3 to 6 month emergency fund. Second, clear high-interest consumer debt above roughly 10% APR. Third, tackle medium-interest debt around 6.24%, or prioritize retirement savings, especially capturing the full employer match where available. Fourth, invest aggressively for long-term growth using diversified, low-cost index funds. Fifth, reassess at least annually, reviewing your goals, risk tolerance, cash flow, and tax situation. Next, let's see how scenarios might differ qualitatively over 5 years. This table offers qualitative 5-year scenarios. With a short horizon, prioritizing the 6.24% payoff yields predictability and reduced risk, though it could miss higher market gains. With a moderate horizon, a balanced split balances compounding with risk reduction, but may not fully optimize either goal. With a long horizon, investing after securing an employer match and paying debt steadily may lead to higher expected returns. But you must accept more volatility. Having compared qualitative outcomes, let's consider the tax angle briefly. Paying off a 6.24% APR debt yields a risk-free after-tax return. To match that in a taxable account, you might need an 8 to 9% pre-tax return, depending on your tax bracket and the nature of investment income. Tax-advantaged accounts, such as a 401k or IRA, can change the calculus, as deferring or avoiding taxes increases the effective return. Consequently, always consider your marginal tax rate and which account you are using before prioritizing payoff or investing. To deepen understanding, let's depict the payoff versus investing mechanics in a sequence view. This sequence diagram shows three actors: you, your 6.24% debt, and the market. When you make an extra payment to debt, you lock in a guaranteed return equivalent to the interest saved. When you invest, returns are variable, though long-term expectations can exceed 6%. Before choosing, check if you have an employer match available and contribute enough to capture it. Avoid market timing and stay consistent. Rebalance annually to keep your allocation and risk in line with your goals. Now, let's test your understanding with a quick quiz. Question: with a 6.24% APR debt and a 3-year goal, which is the most prudent choice? Option A: focus on paying down the 6.24% debt for a risk-free return. Option B: invest all funds into index funds hoping to beat 6%. Option C: try to time the market and wait for a dip before investing. Option D: take on more debt to invest at scale. You may pause the video now to think about the answer. Let's Sheps. We will discuss the answer in the next section of the video. The correct answer is to focus on paying down the 6.24% debt for a risk-free return. With only 3 years, volatility risk is significant. Eliminating this debt delivers certainty and improves cash flow, which often matters more over short horizons. Next, let's check your grasp of the financial hierarchy. Question: which order best reflects the balanced financial blueprint presented here? Option A: max employer match, build emergency fund later, invest aggressively, ignore debt. Option B: build emergency fund, eliminate high-interest debt, capture employer match, then address approximately 6% debt or invest. Option C: invest first, then worry about emergency fund and debt later. Option D: only make minimum payments forever while investing the rest. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct order is to build the emergency fund, eliminate high-interest debt, capture the employer match, and then address the approximately 6% debt or invest. This sequence prioritizes safety and liquidity, removes costly obligations, secures strong immediate returns via matching, and finally optimizes the medium-interest debt versus long-term compounding trade-off. Next, we will map guidance to time horizons on a simple timeline. This timeline maps actions to time horizons. From 0 to 1 year, focus on building the emergency fund and avoid taking new risk, while paying any debt above 5 to 6%. From 1 to 5 years, prioritize paying the 6.24% debt while still capturing the employer match. Between 5 and 10 years, use a balanced split and consider increasing investing if your income is stable. Beyond 10 years, tilt toward investing with low-cost diversified funds and reassess annually. Before we close, let's include an important disclaimer. This content is educational and does not constitute financial, legal, or tax advice. Everyone's situation is different. Please consult a qualified professional who can consider your specific goals, risk tolerance, debts, accounts, and tax situation. With that in mind, let's recap the key insights. Key takeaways. First, paying off a 6.24% APR debt is a guaranteed after-tax return, and shorter horizons tend to favor payoff. Second, over decades, diversified index investing typically outpaces 6% but involves volatility. Third, follow the hierarchy: emergency fund, high-interest debt, employer match, then decide between 6% debt payoff and investing, and finally, long-term investing. Fourth, for rates near 6%, short-term outcomes are often close. Payoff frequently wins due to the resilience it builds. Finally, reassess annually and let your goals, time horizon, and taxes guide the mix. To conclude, let's summarize and send you off with a plan. In summary, align your decision with your time horizon. Under 5 years, lean toward paying down. 10 or more years, consider tilting toward investing. Capture any employer match before fine-tuning the payoff versus invest split. Keep investment costs low and contributions consistent, and avoid market timing. Finally, update your plan annually to reflect changes in your life, income, debts, and the broader market. Now let's close with a quick thank you and a creative call to action. Thank you for watching. If this helped you think through the 6% dilemma, please like the video, share it with someone facing the same decision, and subscribe for more practical money frameworks. Tell us in the comments how you are balancing payoff and investing, your time horizon, and what you plan to do next.